Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Dr. Derek Hosmeyer, Professor of Finance at George Mason University School of Business and a regular contributor to the Wall Street Journal. His research focus areas include ETF and mutual fund performance. We'll cover a lot of interesting topics today, including investing in the current inflationary environment, ESG, buffered ETFs, covered call strategies, cryptocurrencies, and a lot more. Dr. Hosmeyer, welcome back. Great to have you on the show.
Thank you, Nina. Great to be here.
So let's start with inflation, which is the biggest headache for investors lately. It is now running at its highest level in 4 decades. And we know that CPI report for the month of May came in much hotter than expected last week, and that raised concerns that the Fed could act more aggressively to tame the surging prices. And the Fed just announced a 75 basis points hike in its key benchmark interest rate. And this is the biggest increase since 1994. And for the purpose of reference, we are talking on Wednesday, June 15th. So it remains to be seen whether the Fed would be able to engineer a soft landing. But investors have been looking at ways to hedge inflation risks, and they have been pouring a lot of money into assets which typically do well during inflationary environments. And you wrote recently about stocks and industries that do best during high inflation. This story was published in the Wall Street Journal recently, and in fact, you had studied that a couple of years back too. So tell us what does well during periods of high inflation.
Of course, yeah, happy to. So yeah, in general, we know that stocks don't correlate too well with inflation, and in general, don't really do that great during high inflationary periods. Not surprisingly, during inflationary periods, we see that gold, silver, oil, and commodities correlate the most and do the best. So again, that's not a big surprise. In terms of stocks themselves, owning energy and materials companies are really the only two industries that we see that significantly go up during really significant inflationary spikes. On the flip side, tech, utilities, consumer discretionary, healthcare, consumer staples, most of the rest of the market really suffers during inflationary spikes.
So, yeah, we have seen a lot of interest in commodities this year, a lot of money flowing into commodity ETFs, gold too. Commodity ETFs have done very well. Gold, even though it has not really taken off, it's up like 2-3% year to date, but that is much better compared to other major asset classes, stocks and bonds, which are down so much this year. Energy is the best performer again this year, and we have seen a lot of interest in energy ETFs as well. So a lot of experts say that today's the current inflationary environment is very different from 1970s style inflation, which you studied in your in your research on what did well during past inflationary periods, and because interest rates were very high in the 70s, and now, even though the Fed has started raising interest rates, they're relatively at very low levels. So, and there was an oil price shock, which is quite different from the current oil price shock, actually, in the 70s. So, any thoughts on why today's inflation and investing environment may be different from that in the 70s, and is there anything investors should keep in mind while looking at the results of your study?
Yeah, I mean, you're exactly correct. The 1970s were pretty different, both in terms of things like technology and the underlying causes of inflation. As you mentioned, OPEC was one of the main reasons why we had an inflationary spike in the 1970s, due to oil and gas being cut off here in the U.S. And again, we're facing something similar now with Russia and Russia being cut off from markets, but it is a different kind of spike. And I would say that in the 1970s, you didn't have the significant stimulus that we saw here in 2020 that really led to a lot of money being floated around and excess demand. So those are the two differences. Investors should be cognizant that one of the main reasons why we saw inflation in the 1970s is not happening right now. What we saw in the 1970s was a wage spiral. So wages kept going up, and then as wages go up, the price of things goes up, and then wages have to go up more. So that was a significant factor in the late 1970s. Right now, you see kind of wages leveling out, and if some people say they're going back down. So the news now in terms of inflation is not as bad as the 15% or 12% inflation that we saw in the late 70s. So that is one thing investors should be cognizant of. The second is one reason why our markets are really going down so much with interest rates going up is because a lot more of our market is technology. In the 1970s and early 80s, the tech sector was maybe about 15 to 20% of our markets, and now it's getting up to about 30%. Well, by some estimates, it depends on how you measure tech, but you can even say it's 35 to 40%. So that's another factor of why our markets are falling so much right now as interest rates go up.
Right. So as you mentioned, the markets are falling, both stocks and bonds are falling this year at a pace which was never seen in decades. And this turmoil has sent many investors into buffered or defined outcome ETFs. So these defined outcome ETFs usually offer exposure to some broad equity indexes up to a cap, and there is a built downside protection to downside buffer. There are different levels of those buffers, and these defined outcome ETFs have been quite popular with investors lately. In fact, now there are about 150 ETFs in the US markets with total assets under management exceeding $7.7 billion. You did some study on buffered ETFs and whether investors should use these buffered or defined outcome ETFs. Tell us what you found.
Yes, indeed. We looked at kind of the full range of buffered ETFs just about 6 months ago. We looked at their history. We only have history, going back to 2018 for most of these ETFs, just because they're newly constructed. So we can't be definitive in how they're going to perform, but they are kind of interesting. And again, over their short history, they operate with a Sharpe ratio. Again, that's a risk-adjusted return ratio, pretty close to the S&P 500. So, for instance, you can get about, on average over this time period, you can get about an 8% return with a 9% volatility, compared to the S&P over this period delivered about a 20% return with an 18% volatility. So similar level of risk to reward is the way to think of it. The one downside I would really highlight with these buffered ETFs is that their expense ratios are pretty high. So you are going to lose a good amount on the average expense ratio. For instance, most people know by now you can invest in a simple S&P 500 ETF for about 0.10% per year or even less. These buffered ETFs have expense ratios around 0.80%, so much higher.
That's helpful. Another area which has seen a lot of interest from investors is covered call ETFs. In fact, the most popular product in the space, which is by Global X, it is the Global X NASDAQ 100 covered call ETF. The ticker symbol is QYLD. This has gathered over 2.3 billion in assets this year. And there's another one by Global X, which is the S&P 500 covered call ETF, and that has gathered over 960 million in assets. And QYLD has a very nice dividend yield of more than 15%. And in terms of performance too, it has significantly outperformed the NASDAQ 100 index. So you looked at covered calls strategies as well. So I don't think many of our listeners understand what these covered call strategies are. So please tell us what is a covered call strategy and whether investors should use these strategies during volatile market conditions like this year's.
Sure, of course. In the simplest sense, a covered call strategy can be constructed with a long position or buying the stock and then selling call options on that same stock, representing the same size as that long position. And so this will limit kind of the upside payout of the investor, but expose the investor to the downside risks should the stock fall. So this is a very popular strategy, and we were looking forward. We thought the results would actually be better on covered call ETFs that are out there. But when we looked at it and compared it to just owning the plain vanilla S&P 500, again on a risk-adjusted basis, the S&P did much better, and we were kind of surprised by that. Another downside feature of this is that really these covered calls are highly correlated with the S&P 500. So they have a correlation coefficient of 0.94. Again, if you're perfectly correlated with the S&P 500, it would be 1. So it's pretty close to 1. So you're not getting much diversification benefits by investing in covered call ETFs. So the end result was that most covered call ETFs weren't adding as much as we hoped they were ex ante. That's not to say that an investor can't construct their own covered call strategy. So that is a possibility, but the covered call ETFs out there weren't really adding much to the average person's portfolio.
So do you think that these can do much better? They can deliver much better performance in the market when the market is very, very volatile like this year, but over the long term, these do not belong in an investor's portfolio because, as you mentioned, that they kind of underperform the S&P 500 over the longer term, and obviously these are more expensive too. So should these be used as trading tools in a portfolio?
Going back to the buffered ETFs, I think buffered ETFs do offer a good amount of protection and can be used in kind of situations like this. Interestingly enough, when we looked at covered call ETFs, they did the best when interest rates were stable, which was kind of a surprising result. You gain your highest monthly returns when the Fed policy is neutral or stable, where they're just keeping interest rates the same. In a rising interest rate environment, they did not do that well. So kind of an interesting result. So kind of in this environment now where, the Fed's going to raise another 1 to 2 percentage points over the next year or so, we would expect, based on historical results, the covered calls to not do as well.
Very interesting. Now, another area which has been in focus this year is ESG. And in fact, this trend of social responsible or ESG investing, this has been quite popular over the past few years. These ETFs, ESG ETFs, and socially responsible ETFs, they gathered a lot of assets over the past few years, and they did very well because these are typically overweight technology and underweight energy. And we know that tech did very well over the past decade. So investors were very happy. They were doing well by doing good. But lately, over the past few months, we know that tech has been underperforming and energy has been outperforming. So by excluding energy from these ESG ETFs portfolios, investors' performance suffered. And then there has been a lot of skepticism about ESG lately. There have been several allegations of greenwashing by some of the major asset managers, investigations by the SEC, and then investors have been questioning these strategies, like what exactly is ESG, particularly after Tesla was kicked out of the S&P ESG index earlier this month. So you looked at ESG investing strategies and you came up with some very interesting results. Please tell us about them.
Yes, indeed. So yeah, we looked at kind of what are the underlying risks in ESG funds. We kind of looked at how well they correlate to small caps, how well they correlate to technology, do they correlate with change in oil prices and inflation, and in general, yeah, they have greater risk, even surprisingly, to change in oil prices. So they have more exposure to change in oil prices. They're more exposed to changes in inflation. And not surprisingly, interest rate risk. They have higher rates of interest rate risk. And this is exactly because of what you just mentioned. If you cut out certain companies, you need to add others from an ESG portfolio. And so when they cut out certain non-ESG related companies, they usually add in more tech companies. And because you add in more tech companies, these portfolios are extra sensitive to interest rate changes. And that is a risk that ESG investors should know about.
Yes, it is very important for investors to look under the hood what exactly your ETF holds. In fact, you may be surprised. You may think that your ESG ETF will not hold energy companies, but Exxon and Chevron are in fact held in many ESG ETFs because they score low on E, but they score pretty high on S and G metrics. Similarly, you may think that Warren Buffett, who is one of the most charitable billionaire investors, his company, Berkshire Hathaway, you may want to hold that company in your ESG ETF, but Berkshire is excluded from many ESG ETFs because the company scores very poorly on S and G metrics. So you decide what you want to hold in your portfolio, and you will always find an ETF that aligns with your belief. So look under the hood and see what your ETF holds. That's very important. Now, I wanted to then talk about stock splits because these strategies, stock splitting, happen quite, we have seen this sudden resurgence in these stock splits, and particularly some very high profile companies, Google parent Alphabet, Amazon, Tesla, in fact, just announced another 3-for-1 stock split, and that comes out about 2 years after their earlier 7-for-1 stock split. So you studied stock splits, and please tell us whether investors should invest in stocks that have announced a split.
Yes, indeed. Yeah. So, another good study that we did just about a year ago was looking at, as exactly you mentioned, how do stocks do after they split? In general, we saw pretty good performance. Over the next year, you can expect about a 1 percentage point outperformance against the benchmark. So to keep it simple, if this S&P goes up 10%, you can expect your stock split company to go up 1%, or sorry, 11%, excuse me. So 1% over the benchmark. The one time where you definitely do not want to invest in stock split companies is during boom years. So we looked at years where kind of valuation ratio is really high. You can think of 1998, 1999, 2007, 2018, years where we are really kind of up there on valuation ratios. During these years, this is the worst time to invest in a company that splits its stock. We saw underperformance by about 3 percentage points in these years. So again, if the S&P goes up 10, we would expect this company to go up 7%, so a negative 3% abnormal return.
So that's very interesting. And what do you think is the reason for this outperformance? Is it because the stock, which was earlier very expensive, and after splitting, more investors are able to invest in that particular stock, or option traders are able to use that stock? Is that the reason why these stocks outperform in the months after the split?
Yeah, there's a whole host of kind of studies out there, or speculation on why this might be happening. Investor sentiment, catering to investors' preferences, catering to retail investors, as you mentioned. We didn't exactly go into those, but my guess it would be a combination of those, and probably definitely catering to getting retail investors really back into your stock and trading on that stock.
Talking about retail investors, many retail investors have taken a beating on their cryptocurrency portfolios because cryptocurrencies, Bitcoin, Ether, all these cryptocurrencies continue to be battered. And in fact, today, Bitcoin briefly fell below $20,000 for the first time since December 2020, and it is now down more than 70% from a high of over $67,000, which was touched in November of 2021. And now there are, everyone is talking about crypto winter, but there's, questions about investing case in cryptocurrencies, because earlier people used to talk about diversification, inflation hedge, cryptocurrencies, Bitcoin being the digital gold. But we have seen that they have failed on all those fronts. So tell us whether investors should have any exposure to cryptocurrencies in their portfolios.
That's the the $100,000 question. That's a tough one. I think I'm not the biggest proponent of crypto, but I think for most investors, you can't completely sit out on the sideline. Again, I have very little faith that over the long run, it's gonna, like Bitcoin will be worth 20,000 a coin like it is right now. But it's hard to sit on the sidelines when all this is going on. I think most financial advisors are, advising, maybe 1 to 2% of your portfolio. If you're extremely bullish on it, maybe you're going up to 5 to 10%, but I wouldn't go at much beyond that.
Yeah, I think 1 to 5%, depending on the risk tolerance, makes a lot of sense. It is a new, technology, a very new kind of financial technology, which may gain momentum in the coming years. So yes, some exposure makes a lot of sense. And if you look at the long-term performance of Bitcoin, it is still very impressive despite this recent plunge. But limit exposure according to your risk tolerance.
Yes, I think that's the safe and prudent way to handle it.
Okay, now I want to discuss Barbell Strategies with you. And, we hear about Barbell Strategies so frequently on CNBC and Bloomberg. So tell us, what exactly are these barbell strategies, and do they make sense in the current market environment?
Yeah, exactly. Anytime you turn on CNBC, you always see some advisor up there recommending barbell strategies. I've actually never heard an advisor up there recommending the opposite of a barbell strategy. I don't know what you would call the opposite, but I've only heard them recommending barbell. So, so what a barbell strategy is basically you cut out the middle of some metric. So if you're looking at bonds, you could do a credit barbell, where you're taking high credit quality companies and low credit quality companies and forming a portfolio, again, cutting out the middle. If you're looking at stocks, you can do a valuation barbell, where you're taking high PE companies and low PE companies and forming a portfolio that way. If you're looking at duration, you could do long duration bonds and short duration bonds, but again, cutting out the middle. And so we looked at all kind of varieties of these barbell strategies. And the interesting thing is, like a lot of analysts claim on CNBC, it does hold that these barbell strategies seem to work best when interest rates are going up. And we didn't get into why this is the best strategy when interest rates are going up, but we definitely see an outperformance of barbell strategies when interest rates are going up. So that was a kind of an interesting result that should be coming out soon in the journal.
We'll keep an eye on that. In fact, I had studied pure value and pure growth ETFs. Invesco offers a suite of those pure value and pure growth ETFs. They have RPV and RPG for S&P 500 pure value and pure growth. And we found that was done some time back. And we found that if you hold just those two ETFs in the portfolio, pure value and pure growth, and cut out the middle bucket, then your portfolio outperforms over the longer term. But obviously, historical results are no predictor of future performance. But that was an interesting result that we saw. So that was a very interesting discussion, but I wanted to end with something much more interesting than the financial markets, and that is Wordle. And this is a game which has become very popular. It has gone viral, in fact, and it's an easy game like a mini crossword. Just takes a couple of minutes or a few minutes at least, and you can play it only once in a day, and then you can share your results with your family and friends. So I saw that you studied Wordle strategies, and you came up with some strategies that do well. So tell us about them.
Of course. Yeah, this is a fun little departure from finance. I had two really strong students of mine that were good programmers, and right when this game came out, or really captured the zeitgeist, we jumped right in and said, well, how can you play this game optimally? What's the best first word to start with? And we found some kind of interesting results. If you're looking to win and just win in general, in the 6 allotted guesses, we found the top words to be adept, clamp, and plaid to start off with. And if you start with those words, you have almost a 99% success rate of winning in the allotted 6 guesses. If you're trying to play get it in the fastest amount or the fewest guesses, then slice, tried, and crane are the top words. Slice being the top one with an average guess to solution of 3.89. So on average, if you play slice as your first word, you should be able to get there in about 3.89 guesses if you're playing, again, optimally. And so that's a little caveat there. You need to be playing optimally. But some interesting results. We kind of ran through all the 5-letter words out there in the dictionary and came across these results, and we put it out there, and we had a lot of feedback from people.
Very interesting. Awesome. So remember: crane, adept, clamp, blade, slice, tried, and Crane if you want to do well and if you want to impress your family and friends on Burdle. So that was really interesting, Dr. Hostmeyer. Thank you so much for your excellent insights as always. Really appreciate you taking the time today.
Thank you, Nina.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.